Today's videos is about capital expenditure versus revenue expenditure. Most of the MCQs, tests, the difference between a capital expenditure and revenue expenditure is asked that how one can be able to differentiate between the two types of the expenditure. What are the types, which type of the expenditure would be treated as the capital expenditure, and what type of the expenditure would be treated or identified as the revenue expenditure. So there is a simple trick that all those expenditures which have the benefits exceeding 1 year, and that is simply that those expenditures whose benefit would be derived for more than 1 year are simply treated as the capital expenditure, whereas those expenditure the benefits of such expenditure would be for more for 1 year or less than 1 year would be treated as the revenue expenditure. So simply those expenditures whose benefit would be derived for more than 1 year would be treated as the capital expenditure, and those expenditures whose benefit would be for 1 year or less than 1 year would be treated as the revenue expenditure. So the simply capital expenditure are exposed to the revenue expenditure these are non-recurring, that these the capital expenditure are the expenditure which are treated not very regularly as opposed to the revenue expenditures. The examples of such capital expenditure would be the purchases costs, delivery costs. Why delivery costs are treated as the capital expenditure? As we know that the cost of any thing, that is for example a cost of any asset would comprise of all those charges which starts from purchases till till the asset has been placed for final use. So all such costs would be the part of the cost of that particular asset. So purchase cost, delivery cost, legal charges, that during the incorporation of a company, for example, there are legal charges. So the benefit of such charges would be derived for a longer period of time. Such costs are known as the capital expenditure. We can say that those costs which are intended for the acquisition of assets is known as the capital expenditure. For example, if we are going to expand our assets, there are the upgradation costs. These would be treated as the capital expenditure, as the benefit would be derived for more than 1 year. In contrast to the capital expenditure, we have the revenue expenditures. So the revenue expenditures are such expenditures whose benefit would be derived for 1 or less than 1 year, and these are usually the routine expenditures, that is the expenditures which are done on the regular basis, on the routine basis, as well as these type of expenditures are done for the maintenance of the assets. Revenue costs include, for example, the maintenance cost, repairing costs, renewal expenses. So there simply all those expenditures whose benefit would be derived for more than 1 year would be treated as the capital expenditures, and the such expenditure would be treated as the asset, and the process would be called as the capitalization. While on the other hand, the revenue expenditures are done for the routine activities, and such expenditures will be treated as the expenses of the current year. So if we for example look at the comparison chart of the capital and revenue expenditure, so the expenditure incurred in acquiring capital asset or improving the capacity of existing one would be treated as the capital. So on the other hand, the day-to-day expenditure would be treated as the revenue expenditures. Again, the capital expenditure are of the long-term nature, as exceeding more 1 year, while the revenue expenditure of the short-term, usually 1 or less than 1 year. The capitalization process, yes, it is for the long-term for the capital expenditure, while there is no capitalization, as these expenses would be treated as the expenses of the current year. The capital expenditure is shown in the income statement as well as in the balance sheet, while it is the revenue expenditure is shown only in the income statement. outlay is that these are non-recurring. It means that these are not done on the continuous basis, on very frequently. While on the other hand, the revenue expenditure are done on the routine basis, on the daily basis. So that is a recurring benefit. Of course, that the benefit for more than 1 year, while in only the current accounting period. And the earning capacity seeks to improve the earning capacity that of all such expenditures which are done for the acquisition of the assets, for the placement of the assets, for the renewal of the assets. These are basically intended to improve the earning capacity of the fixed asset. That's why these are treated as capital expenditures, while the revenue expenditures basically maintain the earning capacity of the asset. That is, for example, the repair and maintenance cost, etc. Matching concept, that is the revenue is matched with the current period expenses. So this is there is no need of the matching concept over here in the capital expenditure, while in the revenue expenditure, as these are the expenses which are incurred in the current period, so they must be matched with the revenue of the current period. So that's why we have to follow the gap principle, that is the magic concept. So for example, the most of the corporations have their policies, they have procedures, they have the demarcation that what type of the expenditure should be treated as the capital, it should be treated as the the revenue expenditure. So two things are over there. One is the time duration, and one is the each company has set for themselves their own minimum amount of the dollars, for example, that if the benefit are usually for more than 1 year, and the amount is exceeding, is more than the threshold, then they will be treated as the the capital expenditure. On the other hand,